New mortgage rules have been put in place since the government passed the Dodd-Frank Act nearly 5 years ago as a response to the financial crisis. The legislation and the consumer protections that grew from it have imposed a vast array of new regulations on both lenders and borrowers. But are we better off, safer when it comes to mortgage lending? Diana Olick looks at the results.
The effect of loose lending during the last housing boom was abundantly clear. Nearly 7 million U.S. homes lost to foreclosure. The response, a credit lockdown caused by new lending rules under Dodd-Frank.
For lenders, this is all about paperwork, verification, and doing a lot of the grunt work that was ignored or passed over before the crisis.
The rules fill thousands of pages but are pretty simple. Highly risky loan products were banned. Borrowers now have to document their employment and debt levels. Lenders must disclose all the costs involved in each loan, and most importantly, lenders must verify a borrower's ability to repay.
If you're a high credit quality consumer, Dodd-Frank just made it a much bigger pain in the butt to get a loan. You got to fill out more paperwork. You got to dig up more tax returns. You got to find information related to retirement accounts, stuff that was never asked for before. But if you're on the low end of the spectrum, it has made it tougher to get that mortgage.
Tight credit is blamed for a still falling home ownership rate, now at the lowest level in a quarter century. Even the Federal Reserve Chair, readying to raise interest rates, is on that bandwagon.
Demand for housing is still being restrained by limited availability of mortgage loans to many potential home buyers.
Tight credit is also blamed for a shift in the lending landscape. Large bank lenders are moving out and independent non-bank lenders are moving in.
I think Dodd-Frank, not only does it add complexity, but it adds a lot of confusion.
It also adds significant costs in both time and labor. Big banks have other businesses that are more lucrative.
There are so many ways to make a mistake, and the banks learned from the financial crisis that the regulators will keep coming after you over and over and over again for these errors.
So lending is less attractive to big banks. As a result, non-bank lender Loan Depot has tripled in size in the past year. But its CEO claims Dodd-Frank is forcing compliance at the expense of innovation.
It's always about making certain that we double check, and once we do that, we triple check, and then making absolutely certain that all the I's are dotted and the T's are crossed, because if you don't and you make a mistake, once you make a mistake as a lender, you're not going to be around for long.
The home loans being made today are arguably the most pristine in history, but they're also being made at the slowest pace in decades. For Nightly Business Report, I'm Diana Olick in Washington.